Good morning. How the 10-year Treasury is quietly shifting CRE pricing at the end of 2025 as we roll into 2026. And if you invest in commercial real estate, the 10-year Treasury or the 10-year is one of the most important numbers in your world, whether you track it daily or barely think about it. But why? Well, the 10-year acts as the gravity of CRE pricing. When it moves, everything from cap rates to loan terms to purchase prices start shifting, and sometimes subtly and sometimes dramatically. But today's market is experiencing exactly just that. So, the why of the 10-year Treasury matters for commercial real estate. Well, commercial real estate values are directly tied to borrowing costs. And borrowing costs are tied to benchmarks like the 10-year Treasury, SOFR, 5, 7, or 10-year Treasury, commercial MBS spreads, as well as bank risk premiums. And most permanent CRE loans, including life company loans, commercial mortgage-backed securities or CMBS, Freddie Mac, FHA, so agency multifamily products, as well as some bank products. And all prices are based on the 10-year plus a spread. So when the 10-year jumps from 3.5 to 4.7, the impact cascades. It means higher interest rates, which means higher debt service, means lower leverage and lower cap rate, and lower buying purchasing power, and ultimately lower property values. So, what's quietly happening in today's market? Well, most investors feel the softness in pricing, but many don't understand why. And here's what's really driving it. Well, the first being that the 10-year Treasury has stayed elevated longer than expected. And investors began 2024 expecting rate cuts in the beginning of the year. But inflation has stayed high and sticky, and the 10-year stayed above historical norms. That stability is creating softer valuations, also reduced speculative buying, and wider bid ask spreads. And this can be especially true for several different property types. So, first being that comes to mind is office buildings, as well tertiary markets, or Class B and C multifamily properties, or stabilized industrial with low NOI growth. Number two, cap rates are repricing to match higher financing costs. So even if sellers haven't accepted it yet, the market already has. And a property that traded at a 5 cap in 2022 when rates were at 3% cannot trade at a 5 cap when rates are at 6.5%. So the today's spread no longer works, is the point there. And this is why investors are insisting on some of the following. So cap rate expansion, some seller credits, some price reductions, assumable loans if you got them, or creative financing structures to work around the higher cost of financing. Number three, debt service coverage ratios are squeezing loan to values. So banks and non-bank lenders are protecting themselves by lowering leverage on properties. Instead of 75% loan to value, many deals today qualify at 55 to 65 loan to value because DSCR doesn't pencil. And that alone is going to push asset prices down when sellers can't get what they're asking anymore. So number four, certain asset classes are thriving despite of the treasury volatility. And not everything is soft. Some sectors are enjoying strong capital demand regardless of interest rates. Some of the first that come to mind are industrial and logistics properties, or medical offices, or storage centers in primary markets, as well land in fast growth corridors. So think Katy, Fulshire, I-10 West. Build to rent communities, or BTR, is a great asset class for that as well. And these asset classes are powered by demographic growth and not just cheap debt. So, what are smart investors doing right now? Well, they're watching spreads and not just the 10-year. A 25 basis point drop in spreads can matter more than a 10-year drop itself. And when that happens, you need to lock in early if rates dip. And treasury dips are happening in 48 to 72 hour windows. And we've got a potential Fed rate cut coming up in December. So we're targeting sellers with adjustable expectations, especially in tertiary markets and office buildings. And we favor high growth metros. And Texas remains one of the strongest in the nation still. But we can also look at using creative financing, assumptions, seller carrybacks, rate buy downs, bridge to permanent strategy. And here's the bottom line that the 10-year Treasury is repricing CRE quietly but powerfully. So if you're an investor, a developer, or a business owner, you must track the 10-year Treasury just like you track vacancy rates, rents that you're able to obtain or charge, your supply pipeline, as well as new construction costs. Because over the next 12 to 18 months, there's going to be a fantastic window. And the investors who buy when the Treasury dips will get the best pricing. And the ones who wait may miss that window. So, my website is houstonrealestateBrokerage.com. There's a lot of free tools and resources as well. You can schedule a consultation with me there. That is it for the day. Have a good week.